All right, what do you say, guys? Should we get rolling?
Let's do it.
All right, great. We'll have some more people trickling in, but let's get going. So, everybody, thanks for joining. My name is Danny Condon. I am Chief Revenue Officer at Blockware Solutions. Um, Today, we're going to be covering a number of different topics. Macro, certainly a lot going on in that environment. We're going to talk about equities. So from both from an equities and more specifically a Bitcoin exposed equities perspective, we'll talk about on-chain and derivatives, what we're seeing in that world, as well as mining. So we're going to kind of go through the journey from, top down, right? And we've got a couple other folks that are going to be joining or that are going to be speaking. So Warren Rogers. Warren is CFO at Blockware Solutions. He's going to be kicking us off on the macro front. Then we've got Blake Davis, who's going to pass the torch to, covering equities with the focus on Bitcoin exposed equities. Then over to Will Clemente. Will will be covering on chain and derivatives, and then Joe Burnett is going to be covering mining, and then we'll just jam. We'll probably be chiming in on a number of different topics throughout. But again, everybody, thanks for joining, and we can get rolling. Before we start and pass it over to Warren, just a brief kind of intro for those of you who don't know Blockware Solutions, as the speakers here are all Blockware folks. We're a leading provider of vertically integrated Bitcoin mining solutions. So we sell Bitcoin mining rigs, and we also offer co-location hosting services. It's always nice. We get a number of customers and longtime clients tuning in. So if you want to learn more about Blockware, feel free to give any of us a shout afterwards. But this is not about us. This is about what's happening in the world. So Warren, with that, why don't you get us started just talking about the macro landscape and what you're seeing?
Sure, Danny. Thanks a lot. Hey, everybody. Thanks for making some time for us to talk about the markets today. Um, I'm not sure if there's, people who have been with us since we really started covering inflation, back in October. It's almost been sort of a one-way, story that we've been preaching and, trying to understand how what we predicted would be a pretty significant inflationary environment, how that would affect obviously the price of Bitcoin, which is our bread and butter, but how that translates into every other area of our lives. And I think that we'd all agree, just even today, the last week, the last month has just been nonstop news flow in the macro environment that's been exhausting, is the way I would characterize it. As we said, inflation is like our primary focus right now in the macro markets, and it's driven by, a lot of things, but principally from the price of energy. But we've had meaningful increases in the price of food and shelter and all these other things. But, on the macro basis, it's just, this inflation story is continuing to whip around the markets quite significantly. Today, the data, coming up near 10% inflation, 9.1 reported today, highest since the 80s. We've been calling this for a long time. This reading was driven primarily by big jumps in inflation, where, X food and energy, which are the most volatile components, were actually 5.9%, which is basically what it was last month. This is an interesting thing to kind of discuss about kind of like where we go from here. And, my case is that, I personally believe that we're going to go, much higher because, I believe inflation is largely, it's kind of self-fulfilling is one thing. And then it also just takes a lot of time to tackle. So, I mean, the first thing is just how do we deal with this and, and what's going to cause the next. And so, as we've seen, like energy has really led this. And, the war, Russia and Ukraine, put, significant upward pressure on energy prices, which, it's there's no isolated economies anymore in the world that fed through to the US. I would say that it's going to continue to go higher because, we've still got August, which is a big driving demand season in the US, big cooling demand for, power plant demand of natural gas, all over the northern hemisphere. So that'll probably continue tracking higher. Maybe there's some abatement, in the fall. But then as we get into the heating season, now very importantly, big drivers of the inflation is energy. Natural gas is now a global commodity, not just a local commodity, because it can be liquefied and shipped. With the pressure on Europe, to import more gas, puts more pressure on U.S. when our gas storage levels are just really within the last 5-year averages. our strategic petroleum reserves are at a very, very low level, there could be a significant jump in inflation, into the winter. And so it's how does the Fed react to this? So, the Fed, the clearly, they're looking at the same things. They're looking at there's going to be probably a big demand shock for energy and a big supply shock at the same time. And they're seeing that their sort of drip approach to addressing rates just hasn't been working. So my call would be that they kind of they raise by 100 basis points later this month, and that just sets up further increases of the same magnitude. My view would be that you get to a level of Fed funds around 5%, within the next 6 months, because again the Fed's always from the back, chasing this from behind. And something that I thought was interesting in one of our team calls today was that a lot of people get that the Fed, they obviously have the job of managing interest rates, but their primary objective, their primary job, and the Fed Act was that they're trying to maintain full employment. And so we're getting to this really, really difficult crux now where we have high inflation, and right now employment is still holding very strong, and it's only a matter of time before that starts to weaken. So on the macro, what I'm looking at is, the 10 biggest employers in the United States, when do they start announcing that they're not hiring? Like Google announced that they're not going to make many new hires this year. If say, a company like Walmart, starts to report negative data, which is one of the biggest employers, some of these other countries, you're going to know that unemployment is going to start to track up, and the Fed then will really have a problem, because being that employment is so tight, part of the inflation problem is that I mean, you could see unemployment basically double, and it would still just, you could have unemployment around, 6%, 6.5%, and that would still not be too far from full employment. And that's a huge shift in both policy and an election year. And, you got midterms coming up, you've got these huge shifts taking over, and the markets are going to just get even more volatile. And I think that, if we see the Fed really act and you see some abatement in interest rates in next month, the market should stabilize some on the macro, but it's just going to take some time. And, for that, you know, Bitcoin is just going to continue to, unfortunately, in my view, just kind of track equities to some degree. But, well, it is just going to take some time to really figure out which way things are going. We're kind of in the messy middle, is what I would describe it as.
Yeah, man. No, I mean, there's great insights, and there's obviously a lot to unpack there. Um, one thing we'll double back on as we move through the spaces today is that really astute point with regards to employment. Being high, and job numbers were good. You know, that in many ways is a good sign of economic activity. From a macro perspective, to your point, there's a bunch of shit going on, right? It's kind of a combination of a lot of things boiled up with the manifestation of loose monetary policy being one factor, a major factor that creates significant inflation, right? So at some point, it's like, do we start to see a bleed in the employment numbers, and then what reaction does that uh, catalyze, right?
Yeah. I mean, inflation is it's like such a silent killer in some ways. It erodes savings, it erodes, your future prospects. It makes everything more difficult in your life. And, the politicians are going to try to figure out a way to play this in their favor, I'm sure. But it sets up these situations that are remarkably difficult for everyone. That these things, these problems were created, since the 2009 policy response to the Great Recession. It's gonna take some amount of time to get these things back in order. And I think like the where the markets usually get it wrong is the time scale. Some things move incredibly quick, and some things just seem to take a long time. Things like inflation, they take quite a long time to get under control. And I think that, as unemployment rises into a period of high inflation, there's a significant, amount of policy, changes, and there's going to be, a lot of volatility around this going forward, because in a midterm year, you're going to be seeing a lot of a lot of politicians who have banked on this are going to be trying to back away from it and freaking out on what to do about it.
Yeah, absolutely. Another thing to keep an eye on in currently in relative strength zone is, you talked about employment, real estate, right? I mean, it's logical to see that real estate should be, as a laggard, start to take a pretty big hit. And if that coincides with unemployment, you almost have like a macro contagion kind of environment of sorts. Right. So, I mean, I think the strategy now, to your point, is just pound everything flat and try to focus on, mitigating this one issue, right? But there's a lot of other compounding issues circling around, right? Which on the plus side creates, in theory, depending on the time horizon, a massive blood on the streets opportunity, right? Just to
Yeah,
kind of
absolutely.
spin a little
Yeah.
positivity into it too, right? I mean, it's everybody looks back and says, "Man, I wish I could have done that," or the other thing when we're sitting at all time highs, but um, when it gets dark quick, right?
I mean, that's exactly right. But I mean, that it warrants to speak about, some of the positives here. Is that, look, guys, let's be frank. There's been a whole generation priced out of buying a home, right? There's been a whole generation who can't basically afford rent, so that everything has run up on them. The zero interest rate policy was a political tool designed to benefit the elites, and it certainly did. And it has, created a very difficult situation. But for us, maybe there's a few, billionaires on today, but most of us normal folk, look, equities are going to get cheaper. You can invest more in your 401k. Bitcoin, it's proving on its own. It's going to be stable. I mean, the upside in this is incredible. Your opportunity to buy real estate, there's huge opportunities that will come out of this. And, for those interested in mining, the price of hardware follows the price of Bitcoin. I haven't seen mining rigs this cheap until like 2019. And I mean, there's huge opportunity, but it's just like, I think patience is a virtue here, and just kind of understanding that, like, not everything moves in the same direction at the same time. Mining rigs have become cheaper, but yet homes haven't really become that much cheaper yet. It's kind of like you got pick and choose, and there's not just one big signal where it's like everybody just jump in. I think you got to be very, very selective, but there's huge opportunities even right now before, we've totally settled into a new, or a different kind of macro environment.
Yep, for sure. No, spot on, and it will continue to be interesting for sure. So let's go over to Blake. So Blake is a equities analyst at Blockware Solutions. Blake, what are you seeing, from an equities market perspective, and then also more kind of Bitcoin exposed equities?
Yeah, cool. Warren, that was awesome. And I don't want to beat a dead drum here, but I want to piggyback a little bit off what Warren was saying, and repeat some things that I think are super important in macro right now, and then kind of take the long road to tie that into what I'm currently seeing in the equities markets. And I like to clarify this in the newsletter, and I've written a thread on it on Twitter. But I just want to clarify here in case people are unaware. But CPI has a lot of issues in the reporting and calculation methods, and it isn't totally accurate to actual inflation levels, because, as Michael Saylor likes to say, inflation's a vector. What that means is you can't measure the price or the price increases for cars and gas and houses and cheeseburgers, whatever, using just one number. But CPI does give us one number. But inflation affects different goods in different ways. But that being said, CPI is a key tool that the Fed uses to gauge whether or not their policies are working. So one thing I like to look at is with the CME group, and they track the Fed futures contracts to determine probabilities of future interest rate changes. And unsurprisingly, after a hotter than expected CPI report for June, CME is now predicting roughly a 70% chance, I think it was 67%, of us seeing a 100 basis point rate hike in next time FOMC meets in 2 weeks, which would be the first full 1% Fed funds rate hike since '88, which is interesting. And one of the basic laws of finance is that bond prices and interest rates have an inverse relationship. So when you see higher interest rates, you should see lower bond prices. And because bond yields are used as a discount rate to evaluate equities, what we would expect to see is that bonds and stocks would be selling off here in order to price that information in. But at least as of today, we didn't see that. The market essentially closed flat, but we gapped down 2%. So we had a pretty strong recovery intraday. But obviously, one day's reaction to news is not enough to, quantify how the market's going to react. But I found it pretty interesting. And I kind of alluded to it in a tweet yesterday, but, the market will almost never do what people are expecting, right? The last 2 days we saw stocks selling off ahead of the CPI announcement because, think about, like, if you scroll through Twitter, everyone is talking about the CPI announcement. Everyone's saying, "Oh, it's going to be hotter than expected CPI." And like I said, the market never does what the crowd's expecting. So my line of thinking was kind of that if everyone's selling stocks because they're expecting high CPI, there's essentially one of two things that could happen. Either we get a CPI that's less than or equal to analyst estimates, and everyone's going to buy their shares back, or we get higher than expected CPI, but everyone's already sold their stock. There's no one else left to sell, other than maybe some late shorts, and you get a squeeze and a buyback, which is what I think we saw today. But like I said, one day of price action isn't enough to even remotely make an observation that we're going to get a bounce significantly here. And I won't make a prediction. I just observe price action, and for the most part, the Nasdaq's just been range bound. And what looks to me like a bear flag, in Bitcoin's done it as well. What looks to me like a bear flag for about 3 weeks now. So is the bottom in? I don't know. Nobody knows. Obviously, the macro landscape has everything or a lot to do with this. And I find it hard to believe that if there's worse to come on the macro front, we won't see lower stock prices at this point in the cycle, at least, because I personally, personal opinion, I believe we're still likely in the midst of a bear market and not at the end of it. But that being said, the stock and bond markets, and Bitcoin as well, are forward-looking pricing tools. So what that means is that they immediately take into account all news, expectations, rumors, opinions, in order to price in future information. So if we look back on history, the stock market always bottoms before the economic issues sort themselves out. And mostly this has to do with investor sentiment. So when there's terrible sentiment and everyone's fearful and scared of lower prices, people are going to sell their stocks to protect themselves. So what happens is by the time the bad news actually happens, everyone's already sold and the market bounces. And I've used this example in the last few spaces. We do a space every Friday to discuss the newsletter. But I think one of the best and most recent examples of this was in 2020. So the market bottomed on March 23rd, 2020, which was when the news cycle was at its worst, right? That's when the White House is saying, stay home, quarantine. That's when people are going to the store and buying $100 worth of toilet paper. Everyone's freaking out. No one knows what to expect. And that's when the market bottoms. So historically, we need to just keep an eye on stocks and bond prices, instead of CNBC headlines to tell us when to get in the market as investors. On the Bitcoin equity side of things, I think we've seen some glimmers of relative strength in a few names, and I've been discussing this for some time in the newsletter. But I think MicroStrategy is a name that stands out to me in particular. Obviously, that's not an endorsement to go buy some MicroStrategy at the open tomorrow. But there are just a few signals that institutional investors are accumulating shares in some of these names, at these levels. Obviously, these names are 80% off their highs. Most of them didn't recover from the April 2021 Bitcoin top. So it's clear to me that the big whales, the institutional investors, are beginning to accumulate shares. Now, are they accumulating all their dry powder? Clearly not. We're not seeing these prolonged rallies in massive green volume, but we're definitely seeing signs of slight accumulation. And kind of going back to what Danny and Warren touched on, and I think maybe Joe and Danny will discuss even more in a little bit. But what we're seeing is that I think newer people that are newer to the space are scared to get involved down here to buy some Bitcoin or to buy some equity or whatever down here, because it's scary and you've never been through a full market cycle before. which I think is bullish because when price turns around, there's all this capital on the sidelines. But what we are seeing are these, the big sharks, the high conviction players. They smell blood in the water, and they're pouncing on the opportunity to acquire, whether it's spot Bitcoin or the related equities or mining rigs for, half the price they were, 7 months ago. So, like you guys said, I think it's a, awesome time to be a long-term investor and start, deploying some capital into a longer term account with a long term time horizon. But I see no reason to be trying to long trade anything down here, other than obviously long term accumulation. But that's kind of what I'm seeing on the equity front. I can pass it off to Will, or if we have any
Yeah, Blake,
questions.
couple things real quick, and want to see if any of the other speakers have any thoughts, but I want to just kind of pin a couple of those. So as you talk about institutional movement, or whales starting to position, so on and so forth, right? I mean, like, it happens when things are dark. And Joe, as we get into mining later on, we can talk about what we are seeing from that perspective, who's buying, who's selling positions, uh kind of just cover those waterfronts. uh that's the primary one, right? Because there's gonna be, as you think about kind of hitting on another point of the forward looking nature of the market, you have this, uh, like, at what point is all the bad shit baked in at a really, like, non fundamental, just kind of conceptual level, right? Because as a reaction to today's inflation number, people are kind of normally talking about 100 basis point, hike, right? So it's like, you know, on one hand, we're almost approaching a bad news as good news from an inflation perspective, because you can kind of think, it's running hot and this will be the hottest one. And then it's going to start cooling off. And when it cools off, the party's on. Right. But, in reality, there's probably more punches to take. So let's definitely keep a focus. And Will, love to hear as we get into, it's probably a good segue to you, unless anybody has any thoughts here, with what Blake has mentioned on what we're seeing from an on chain, and just what some of these whales are doing. How are they looking? Where are they swimming?
Yeah, sure. Everything you said, I think makes a lot of sense. Um, I think from Bitcoin, like part of where I've evolved to view it from where it kind of sits on the broader macro landscape is, I think for a while we've kind of spoken as Bitcoin is, an inflation hedge in terms of CPI inflation. And I think, at least for me personally, and I've seen this narrative taking off a bit on Twitter as well, not saying I was the first one to say it, but I've been seeing, this narrative of Bitcoin is a debasement hedge rather than a CPI inflation hedge, and I think those things can go hand in hand, right? You can have a massive amount of debasement, which has kind of perhaps a delayed effect into translating into CPI inflation. But I think if you go back and look historically at Bitcoin's behavior relative to, we have a relatively small sample size because Bitcoin's only been 10 to 12 years old. But we go back and look at 2018, for example. Whenever the Fed is tightened, you see Bitcoin correct. Whenever we see an extreme amount of QE, Bitcoin is done tremendously well. So one example of that was 2020, right? As everyone knows, Bitcoin went from 3K to 20K in the year of 2020, basically calling bullshit on the Fed's transitory inflation narrative. And I think on top of that, it just simply came down to the fact that more units were being added to the system. And even if you weren't seeing that translate into perhaps consumer inflation yet, you were seeing Bitcoin's performance relative to the amount of debasement that was being taking place. And then, conversely, towards the back half of the end of the year last year, as it was clear the Fed was going to start, restricting the amount of monetary units coming into the system, and then starting QT recently, you've seen Bitcoin perform accordingly. So that's kind of how, at least my views of kind of what the market has been telling you about how they view Bitcoin. So again, I think it comes down to kind of distinguishing a little bit between like core CPI inflation and actual just flat out monetary debasement. So like to pivot onto some of the on-chain stuff, I'll just run through some of the talking points that we discussed in this recent newsletter. From like a technical standpoint, one of the levels that I think many of the market and broader community, I guess, like pays attention to is the 200 week. This historically has kind of served as support for BTC at these like kind of cyclical bottoming areas. Recently, we've just kind of been hanging out below. We kind of retested it from the underside and got a pretty nasty wick off of that retest. And so, I think there's perhaps some sort of, I guess you call it like a swing trade to be had of, if the weekly can reclaim the 200 week, you could perhaps expect some continuation. Maybe you get some kind of like, trend algos or trend based market participants that step in on that. That's one signal that I've been kind of watching out for. But, for now, we've seen a pretty bad reaction on that underside retest of the 200 week. And, if you go back and look historically at BTC, we have gone below the 200 week very briefly in 2015, but we didn't have several full body candles, below it. So that kind of just shows how kind of unprecedented, I guess you could say, that these times are for BTC from a technical perspective. Uh, Moving on to, if we look at like Bitcoin's performance, this is one thing that I was looking at the other day, and I just kind of put together a little table to just compare, what does Bitcoin look like from a seasonality perspective. Kind of what my thesis has been, and I know Joe and Blake share similar thoughts, has been that Bitcoin is down 70% off the highs on a lot of these kind of valuation metrics, both from an on-chain or trend following perspective. A lot of these things are down at kind of accumulation bottoming areas. Not, that's not saying the peak of bottom is in, but we're in this kind of bottoming zone in terms of valuation. Obviously, some people would argue that this time's different because of the macro environment. And I get that, but I think just people are looking at a way to value things, right? And for Bitcoin, the best way to do that is things like looking at the percent drawdown from all-time highs historically, some of the behavioral dynamics on chain, and then also some technical trend following stuff. So anyway, my point in saying that is I think we've relatively found price capitulation. We've seen almost every single type of entity in the space capitulate, whether that be miners, for example. I guess I'm not going to really name names on this specific call, but we've seen a couple miners have to liquidate some of their BTC holdings. We're starting to see hash rate decline as well, which perhaps perhaps is an indication of people starting to have to unplug because of profitability reasons. Obviously it's been well covered about what's going on with different lenders. 3AC obviously, and one other indication I've been looking at for what looks like perhaps fund redemptions and these things, or just funds just shutting down, has been the correlation of BTC and ETH. So you add the Bitcoin market cap and the Ethereum market cap together, you run a correlation of that to the rest of the crypto market. And so, as many people know, Bitcoin and ETH are the two most liquid crypto assets. And so, seeing like a significant drawdown in the correlation between the two, to me, illustrates some type of forced selling that's being taking place. And we did see that about a week ago, and since then that correlation's kind of rebounded. So that to me also appears like some capitulatory type of behavior. We saw from an on-chain perspective, everything from realized losses to SOPR, which is looking at the last time coins were moved versus when they're being spent now. All these things are showing some heavy realized losses. And so out of everything I just said, the point I just wanted to nail home was that we've seen a lot of capitulation from different entities in the space. And so with that, I think we've kind of found this somewhat of an accumulation range from a price perspective. And I think Bitcoin tends to kind of have capitulation through price and then capitulation through time. And so I think for the remainder of the year, what's likely to come, at least for the next, I would say at least for the next several months, my base case is that we kind of are just going to chop around sideways, very similar to kind of like the bottom of 2018, where the kind of max, quote unquote, like max pain or whatever we want to call it, for crypto wasn't necessarily on that like final leg down in December of 2018, it was, going sideways for 3, 4, 5 months with, everyone forgetting it even existed. And I think I think we've kind of passed the threshold of people forgetting that crypto exists, but, losing almost all the media attention and, retail interest, which I think is from the retail interest side, draw down a lot, but we're still getting heavier media coverage than usual with all these, blow-ups from different entities in the space. So like when that all cools down and we're just going sideways in an accumulation range for 3-4 months, there's gonna be nothing to talk about at all, and you won't hear anything about crypto. Like that's kind of my base case for what perhaps we could be entering into. And in that time, you get this, what I've been calling like capitulation through time, in the sense that if you could snipe the bottom, like in 2018, if you sniped the bottom at like whatever 3,200, that was great. But you still had to hold it for months and months and months until you actually started to see appreciation on that position. So I think that tests the conviction of the market participant just as much, if not more, as the price drawdown is.
Yeah.
So if we look at like Q3 historical performance, Q3 is historically the worst performing quarter for Bitcoin. Q1 is about 54%. Q2 is about 33. Q3 is 9.5. Q4 is 103. So Q4 is by far the best performing. Q3 is by far the worst performing. And so I think kind of looking at that seasonality as well kind of ties into the thesis that we're probably just going to go sideways. And then from like a derivatives perspective, one thing that I'm looking at, and this is something that I talked about on my Twitter at the end of summer, 2021, last year, was we want to really watch to see what the derivatives market is doing and how they're reacting to price action, and trying to gauge kind of what's the dynamic going on between the spot and the perpetual swap market. So I posted the other day this thing and put it in the newsletter as well. This kind of checklist of bottoming reversal checklist that we can look out for. There's a few things in the Bitcoin derivatives market that tend to repeat whenever you have a sharp reversal to the upside. One thing would be open interest. So open interest just tells you how many contracts are open. Doesn't necessarily tell you are those market participants net long or net short. But it just tells you how many open contracts there are, and you can look at where the open interest comes in to try to get a gauge for okay, well a lot of OI is coming in at the lows, but every time you have any kind of pop up, you're seeing a big decrease in OI. So it looks like these market participants that are making up the open interest are more aggressively short. So like you can do that, and you can also look at like altcoin open interest versus Bitcoin open interest. Like whenever altcoin open interest encompasses the Bitcoin open interest, you tend to be reaching some type of month to month type of peak area. So that's another sign to watch out for. But all in all, open interest just tells you how many contracts are open. So you can watch open interest on a like absolute basis in just the dollar terms or Bitcoin terms, and then you can also watch on a relative basis. So we can look at what's the dollar denominated value of Bitcoin open interest relative to Bitcoin's market cap. And so that gives you a good kind of relative size of how many contracts are open relative to the size of the Bitcoin market as a whole. So that's one like kind of precedent, is to start seeing rising open interest. And then in terms of looking for positioning, we mentioned on some stuff that we can look at within open interest, but the best thing that I like to look at is funding rates. So funding rates are based on the delta between spot and perps. So funding rates are the funding payment that essentially keeps the perpetual swap price pegged to the weighted spot index price, which is just a weighted average of all the major spot exchanges. And so, if the majority of traders are, looking to go aggressively long, then they have to pay a funding payment to shorts, and same thing, vice versa. Shorts can pay longs. One thing that we want to look for is a regime of funding in either direction. I think funding is like best used in two ways. One would be looking for like a prolonged regime. The other would be seeing funding go in one direction as price continues in the opposite. So I think summer of last year is like a really good example of this. And I have real time examples of me using these things in the thread at the top of my Twitter, like my pinned tweet. So, like, summer of 2021, you saw a regime of negative funding. So, I guess I could back up even a little bit more. So, if we look at like before the like 2021 bull run, we had really positive funding in that push up in September of 2020. You saw traders get really excited, like, okay, this is the push up to all time highs. Funding got pretty high, and then they completely got wiped heading into October. From like the beginning to middle of October, you saw this kind of mixed to mostly negative regime of funding, which allowed the market to kind of rally and with kind of the perp market in quote unquote kind of disbelief. And that really fueled us into the rally that we saw into 2021. But throughout all of the beginning of 2021, you obviously had a persistent spot bid, mostly through grayscale. And that kind of bailed out a lot of the leverage longs that we had in the system. And that was fully evident through the 3-month basis as well as in funding. Funding got ridiculously high for a very prolonged period of time. And the way I like to think about it is the longer we're in a regime of either positive or negative funding, the more aggressive the move is out of the regime. Because what happens is over time, the longer you're in a regime, the more you're training those market participants to think a certain type of way, and you're rewarding that behavior, right? So throughout all the beginning of 2021, traders were getting extremely rewarded to go super max leverage long on every single dip because we had that consistent spot bid through grayscale. And so, once the longer that goes on, once that the floor falls out through the spot bid, no longer, continuing to bail out those leverage longs, you kind of see the floor just completely fall out, and there's more fuel of longs that have to close out or get stopped out or liquidated that can push us lower, and those are obviously for sellers. And you go into summer of 2021, we saw a prolonged regime of negative funding. And so, very similar to what I just made a point about, throughout all of summer 2021, you basically were rewarding traders to continue to fade every single pump. So we had basically this range. It was like 30K to 40K, 35K was kind of the mid-range. At the beginning, every time you got up to 40K, you saw, people that were being heavily rewarded for shorting the top of that range. Then towards the back half of it, it was every single time you saw a push to the middle of the range. And so you were increasingly rewarding this behavior over a 2-3 month period. And then, at the back half of summer, obviously, towards the end of July, you had this kind of like low volume deviation below 30K. It was clear there was a lot of demand down there, and no real follow through from sellers below 30K. And then on that kind of creep back up from 30 to 35K, obviously price was pushing up, but if you looked at funding was going increasingly negative. And if you had looked at the individual the different venues where perpetuals are offered, you saw venues like Binance and Bybit were extremely negative, while venues like FTX or Deribit were positive. So that was another kind of bit more granular thing that really had caught my eye. But the point of all this rambling is in summer 2020 was a good example of looking at a regime, either positive or negative. In summer 2021, it was negative. And then towards the back half of summer 2021, looking at that dislocation between price doing one thing and funding doing another. And that's something that you would want to watch out for as for reversal to the upside would be a prolonged regime of that negative funding as Bitcoin kind of chops sideways, as well as starting to see that going increasingly negative if we started to see a push up. And then the last thing on the derivatives checklist would be backwardation from the 3-month futures, which historically has been a pretty decent bottoming signal. And that's the one of the three that we actually did see, which means kind of the future term structure is negative sloping. It's no longer positive sloping. which would be Contango. And so like several venues have gone into backwardation. FTX, OKX, and Deribit have all done so in the last month. So that's it for the derivatives. I'm almost done, I promise. And then if we just look at, I'll do like two of these. The valuation metrics. One thing, and I don't want to steal Joe's thunder on the mining front, but one metric that I've been looking at a lot lately is something called the Puel multiple, made by my buddy David Puel over at ARK. The Puel multiple is basically used as, or is created to be used as a proxy for miner profitability. So it looks at the USD denominated value of issuance relative to the 365-day moving average of issuance. So essentially, it's a good way to get a basis on how much revenue miners are bringing in relative to kind of what they've been bringing throughout the last year. And so whenever you get to kind of this bottoming area, it's consistently marked these cyclical bottoms for BTC. We recently entered into that zone. I'm looking at this on the 7-day moving average. And that's confluence with some of the things that Joe will likely talk about as well, from kind of a typical bear market dynamic that you see with miners being very pro-cyclical. The last thing is MVRV. Probably talked about this a million times. People are probably sick of me talking about this, but I think it's one of the best ways to look at valuation for BTC. Realized price basically looks at the capitalization of Bitcoin based on the price that coins were last moved, rather than just multiplying the marginal, price set by the marginal buyer or seller, multiplied by the entire market cap. So you essentially get somewhat of a cost basis, or what I like to think of as a way to view the value stored in the network. Whenever market cap goes below realized cap, by definition, that means the market's underwater. That's taken place at the bottom of every historical bear. So, look, I think it comes down to whether you think that, this time is perhaps different because of the macro environment. I still don't think that changes the fact that Bitcoin on a relative basis is cheap. Just because something is cheap doesn't mean it can't become cheaper. But I think looking at some of these things, it's perhaps, in my view, at least, and I've posted that I've kind of put my money where my mouth is. A good time to start, putting some chips on the table. Obviously, want to maintain, and not financial advice, but obviously want to maintain a pretty large, cash position in this environment for the remainder of the year. But I think it's a good time to start, leveling in with these valuation metrics at such quote unquote cheap levels. I guess to wrap up the final chart, I'll leave, I guess, people with a little hopium. I kind of threw this at the bottom just because, like, everything's like super doom and gloom and whatever. So, we're not all gonna die. Like Bitcoin will survive. And one of the things I'm looking at to illustrate that is the user growth of BTC. So if we look at like active entities, which are essentially just, very similar to active addresses, you're just looking at like Glassnode's forensically clustering algorithms that are like basically looking at like a bunch of, wallet movements and saying, okay, this looks like one, individual on chain, whatever. My point is, so if you look at the growth throughout every Bitcoin bull market, obviously it ramps up really high during that time period because you have all these new market participants just getting in Bitcoin because the price is going up, right? So no idea what Bitcoin even is. They just know the name of it and see the chart that the price is going up, so they buy it. When we head back into the bear, though, what happens is, like, obviously a lot of these individuals that just get into the market because the price is going up. I mean, look, I think when I posted this and said that, a lot of people were like, everyone's in Bitcoin because the price is going up. Obviously, I mean, I'm not saying that people aren't. I'm just saying that the people that have no fundamental understanding of what Bitcoin is, all those people get flushed out. They all leave. All the exuberance obviously gets flushed out in the bear. But what happens is every time we head into the bear market, every single historical drawdown for Bitcoin, we've set a higher low for the amount of users that stay on the network. And I think that's the real signal, is that, despite every single, every single peak, or what, you want to look at in terms of measuring user growth, at the bottom of the at the very bottom of the bear market, that base of the individuals that stay around, and perhaps get into the bull, and then find a fundamental thesis of or understanding of what Bitcoin is. You see that base of people who stick with it down 80%. That base grows every single cycle. So I think that's a good place, I guess, to kind of wrap it up, pass it off to Danny or Joe or whoever.
Yeah, Will, awesome insights, man. I mean, no shortage of things going on, right? Want to unpack one concept there, and you hit on it kind of on the beginning, and then you hit it on at the close. There was, the first is kind of the context of like a relative bottom, right? And then as we talk about like what are some of the long term, medium term gains here? If you think about this in the context of how early we are, in global Bitcoin adoption, and then think about the kind of steps that you have to go through, as an individual and as a, society, and, as a global population to, adopt Bitcoin, right? And also compound that with all the bad news. I think it was you, or it may have been Blake, who said earlier, like, you open up CNBC app on your phone, and now you're seeing, 8 months ago is when you started to see Bitcoin headlines, period, in kind of mainstream media. And they were good. They were exciting. That creates awareness, right? But I think news, naturally, and partially because human beings are psychologically more motivated and intrinsically interested in kind of bad news. It's sad, but it's psychologically true, right? That the media will gravitate towards bad news. But now I'm seeing, you open up the app, and it's, you're hearing about liquidations, and it's doom and gloom. It's scary. What that's doing, kind of in the context of, any publicity is good publicity, is it's creating awareness, right? And awareness is a lead, right? To put it a little bit differently, education follows awareness. So whether I am aware because I'm scared or I'm FOMOing, I'm then aware, right? And then I will likely, it's kind of a conversion rate as you think about this in like a funnel. So, more people are becoming aware because there's more news, covering it in mainstream outlets for good or for bad. So the awareness funnel is increasing. And then you have some percentage of the aware folks who convert to educated folks, right? And then education converts to adoption, right? If you think about this, like, talk to people about Bitcoin. I don't know what it is, or I know what it is and I'm scared about it, or I know what it is and I'm educated about it. And there's not a lot of the conversion rate from education to adoption is exponentially higher, on a percentage basis than awareness to education. Right. So I mean, maybe like Joe, Blake, Warren, from a macro perspective, what does that concept mean? And I know you guys covered a lot of this kind of conceptually at a minimum in the adoption report that you put out, but what do you think about that, kind of mind journey?
Yeah, I just want to, tell a quick story. So a couple weeks ago, 4th of July, I'm at a buddy's house. His uncle's there, who's a portfolio manager, and we start talking stocks and Bitcoin, like I tend to do with strangers. And he was kind of saying, like, obviously, during the bull cycles, you see all the hype, and everyone's excited about it. But from a institutional investor's perspective, there's just so much uncertainty. He said it's so damn complicated. I can't wager my client's capital on it, which I honestly found bullish. Think back to the last major bear cycle, following that 2016 or 2017 top. At that time, how many institutional investors would be seriously considering buying Bitcoin for their clients, or for their fund or whatever? It wouldn't have been many. But now on this bear cycle, you see, everyone knows what it is. It's just about, do they have the education and do they have the conviction to actually get involved? And obviously, volatility is something that scares people too. That's, what everyone says, Bitcoin's too volatile. But nobody complains about volatility when it's to the upside. And what you'll see is, when this thing turns around, and whenever that is, who knows. But when that happens, is you'll see that conversion from awareness to education. People are saying, oh, it's starting to turn around. Oh, I remember in 2020, 2021, that thing was ripping. Like, maybe I need to get back involved. And you start to figure out, okay, what actually is Bitcoin? Maybe now I'll spend the time to learn a little bit about it. And that kind of drives all that institutional dry powder that's sitting on the sidelines back into the asset. And I think the institutional perspective is super important. Obviously, there's the retail piece there as well, which is fairly similar. But I mean, if you look at the stock market, institutional capital makes up 70% or so of the daily trading volume. So just from that perspective, the fact that there is awareness on that front, it's just that fear of being uneducated and thinking it's so complicated that you can't get involved. But that upside volatility, I think, kind of drives that transition from awareness to adoption.
Spot on, man. Let's move to Joe. And Joe, if you want to, you always preach this, and I love it. Like, I think it's right in this vein. Maybe you want to opine on this, and then we can move into mining just in the interest of time. But that, how do you put it? It's that Bitcoin, that volatility is a feature, not a bug, right? And I think that as you look at that, there's a lot of aware people who are uneducated who, in their minds are making an objectively accurate point, right? But there's a huge gap between awareness and education, that your thought on that topic, on that point, kind of does a 180. What do you think about that? And then let's talk some mining.
Yeah, sounds great. So yeah, I think ironically, Bitcoin's volatility actually is a feature and it is not a bug. I think the volatility, what it does is, like you described perfectly, it brings in awareness, helps people get educated, and then it drives adoption. And I think not only that, the volatility is kind of what, not only does it bring in the awareness, but the bear runs kind of shake out all of the weak hands in the market. And so weak hands can be, like you guys were talking about, it can be people that may not understand what Bitcoin is. They may not understand it. It's, one of the best monetary tools we've ever discovered because of its, unique monetary properties of being scarce, portable, durable, and divisible. But it also drives out people that may be too aggressive. Maybe they're using way too much leverage, and when cycles turn on them, they're not prepared and they're not a strong hand. So I think these cycles, and Bitcoin has had multiple cycles where the price has fallen 70-80%. It's one of the only assets that it's done this like 5 times, and every time it does it, it comes back magnitudes higher, not just multiples higher. And so it's a very fascinating asset to watch play out. But yeah, I have similar thoughts to all of you guys on that specific topic. I think Will made a super interesting point at the beginning that I'll touch on real quick before I get into mining, about how many people were describing Bitcoin as this inflation hedge, and now that CPI is coming in at over 9%, many Bitcoin detractors are saying, "What do you mean? I thought this was an inflation hedge." And I think an important distinction to make that Will made very eloquently was that Bitcoin is this monetary debasement hedge rather than a CPI inflation hedge. And I think a key point to make on that specific topic is that the market, whether it's the Bitcoin market, U.S. equities market, the market looks forward, not backward. CPI measures the past, whereas the market and prices and investment or economic goods, that measures the future. So I think a good analogy I've always liked to hear is that the Federal Reserve is controlling interest rates and controlling their balance sheet with QT and QE, and they're kind of driving the global economy at a very fast 100 miles per hour, but they're driving it by looking in the rearview mirror. So they're looking at CPI, which is this past measurement, to actually try to control what happens in the future, to where we all have jobs and we all are not poor and we have stable prices, at least relatively. But I think that's an interesting point to be made. But I'll jump into mining now. For the mining section of this week, I'm quickly going to cover first the report that we're putting out that is kind of like a high level Bitcoin mining. and then I'm going to get into miner capitulation that's going on as well. So the report that we're releasing Friday basically models the relationship between the price of Bitcoin and its mean operating cost of production for modern mining rigs. So it kind of demonstrates this relationship and how it plays an important role in these volatile Bitcoin price cycles and just the long-term monetization of the asset. So there's 6 key points. I know we've been talking for almost an hour now, so I'll run through them quick. But there's 6 key points that are in the report that will be released Friday. So definitely follow us on Twitter, follow the Blockware account, and you'll get to see the report. Subscribe to the newsletter as well. But the first key point is that all Bitcoins are required at one of 2 market prices. The first one is dollars per BTC, and this could also be euros, yen, etc. It could be any fiat currency. And the second price is watts per BTC. So both prices are increasing over time, at least in the long run, but they're not necessarily increasing at the same rate. So I think both prices of Bitcoin grow due to increasing scarcity, which is just a matter of time, Bitcoin halvings, and mining difficulty, and their prices are increasing over time because more users are joining the monetary network due to Bitcoin being the most superior monetary technology we discovered, like I mentioned earlier, because of its unique monetary properties. So that's the first point. The second point in the report is this new metric called Bitcoin energy gravity. And it's basically the maximum dollar price on a dollars per kilowatt hour basis that modern mining rigs are willing to buy electricity at to make a profit. So in other words, it's the electricity break-even price of modern Bitcoin mining rigs. And so from this maximum bid price, it's kind of cool to see a chart of it, which you'll be able to see in the report. And it makes it possible to get a better understanding of when the price of Bitcoin is overextended and when the price may be approaching a bottom. So the third key point in the report is that I think money itself is like kind of fascinating, because for something to become money, it needs to be both scarce, but it also needs to be well distributed, right? If Satoshi pre-mined all 21 million Bitcoin and then tried to sell it to all of us, probably wouldn't have worked out very well. So this kind of scarcity and well distribution, these 2 characteristics together is kind of this paradox. And Bitcoin solved this with its predetermined proof of work distribution mining schedule that exponentially decreases over time with halvings. And so the fourth key point in the report is during times of this historically high energy gravity, which is, again, when the cost of production and the price of Bitcoin are severely disconnected, market participants, which is anybody, basically act in their own self-interest to close this arbitrage opportunity. And during this time, this is typically when we see the price of Bitcoin fall back towards its cost of production. And so this could be people, mining Bitcoin and selling the Bitcoin they mine. It could be people deploying capital into mining instead of deploying capital into Bitcoin. It can be, public miners, trying to mine more Bitcoin as well. It could be ExxonMobil and ConocoPhillips joining the Bitcoin mining industry or partnering with people to mine Bitcoin and then selling all of those Bitcoins that they mine. And so markets eventually, work to close opportunities where there's going to be massive profits. And occasionally that's what happens in the Bitcoin market. The fifth point of the report is that when this starts occurring, when the energy gravity decreases and the price of Bitcoin starts to actually go below some miners' cost of production, the weakest miners kind of end up purging their Bitcoin treasuries and they shut off their mining rigs. So these capitulations kind of historically mark price bottoms in Bitcoin because this large increase in temporary sell pressure, which is the bottom, ends with this significant reduction in day-to-day sell pressure when these weak miners are no longer operating on the network and they no longer, after the capitulation ends, they no longer have to keep selling, their Bitcoin to cover their operating expenses. And so the sixth and final point of the report is just the general conclusion or summary that Bitcoin is this ultra unique commodity. And because it's being actively monetized from zero, where miner operating margins regularly explode higher. And this will, in my opinion, continue occurring. And Bitcoin mining will continue to be one of the fastest growing industries in the entire world. And the challenge, as always has been in the Bitcoin mining industry, will be, can you out survive the weaker miners? And if you can, you're going to well position yourself and your business to capitalize on the next bull run whenever it comes, whether it's 3 months from now, 6 months from now, or 2 years from now. The key is just to survive the bear market and outlast the weaker miners. So kind of that's the general idea of the report. Definitely take a look at that and read it and see all of the charts and the energy gravity metric that we modeled out. But going further, I'm just going to talk about quickly about what's going on right now in Bitcoin mining. And obviously that's the miner capitulation phase that we're currently in, which historically, it could get worse for sure. But historically, the end of the miner capitulation phase is a great time to be getting into both Bitcoin and Bitcoin mining. So there's this metric called hash urban. And according to the metric, we're about 36 days into this miner capitulation. And this metric is very simple. It's basically the 30-day moving average of Bitcoin's hash rate and the 60-day moving average of Bitcoin's hash rate. And capitulation is just when the 30-day moving average drops below the 60-day moving average, indicating that, hey, hash rate is actually trending down. It's not just, random chance. And miners are actually on net turning off machines. And so, like I said, this has been happening for 36 days now, according to this metric. And it's, been clearly represented that many miners, even public miners and both private miners, have been capitulating their Bitcoin treasuries, and some, according to the metric, are turning off their mining rigs. We've seen this with Core Scientific, Bitfarms, Cathedra Bitcoin. They're not necessarily turning off mining rigs, but they are selling large portions of their Bitcoin. And that's just bringing on, added downward pressure here near the bottom. It's bringing down the price of Bitcoin, and it's also bringing down the price of mining rigs because, these large players that were accumulating, massive amounts of mining rigs, driving the price up, now, aren't accumulating as many mining rigs as they were once before. So, it's kind of hard to tell if this is the exact bottom for Bitcoin. Of course, more miners could capitulate. The macro environment could get worse, and et cetera. But during these minor capitulations and directly after these minor capitulations, it's usually a great time to, one, accumulate cheap Bitcoin, and two, accumulate cheap mining rigs.
Yeah, Joe, couple things there, man. Like, love those insights. One thing I want to point out, I think it's central to kind of everything we talked about, is like, just look at the strength. I mean, one being historically Bitcoin price and hash rate being, pretty closely correlated, right? The other being, as you look at like the strength of the network from highs of say 2017 to November of 2020 to now, right? Like, look at how much more secure the network has become in that period, right? I think like one thing that gives me conviction is that you look at all the outside investment, you look at everything that's being poured in. Now maybe it ran a little too hot, at this point, and that's why we're seeing capitulation. There's a lot of things happening. This is times different too because we're seeing capitulation, selling pressure on from miners selling their rigs, but also kind of bigger, fund-based macro issues where you've got, contagion and you're bringing in altcoins into the picture and kind of forced selling from a number of different vectors, right? But just like zoom out a little bit and look at the strength of the network now compared to, previous highs. It's impressive, right? And then the other topic that we've been discussing a lot today is like signs of a relative bottom, correlated with institutional movement, right? And to Will's point, like, maybe some nibbles, maybe not some huge bites at this point, but the whales are moving. So, Joe, you made an interesting point. Maybe you can unpack it a little bit about, kind of like the why mine now, right? I mean, and I'll just kind of kick it off with a couple thoughts is, you think about it at like a super basic level. Um, a miner, latest generation rig is effectively the same widget that it was 6 months ago, right? The yield is different. The dividend side is different, right? The underlying asset price is different, but it's the same thing, right? So on one side of that, just kind of sticking with that narrative, it's effectively like a 60, 70, 80% haircut. It's the classic, buy one, get three free, best deal around kind of thing, right? So, I mean, how does that translate to an institutional mindset? And what are you seeing? I can opine on some of these thoughts as well, but would love to hear your thoughts on kind of that topic.
Yeah, I mean, I think like Bitcoin, it's like we were talking about where or where these news cycles where funds are blowing up, lending crypto, Bitcoin lending platforms are blowing up. It drives awareness for Bitcoin. Now, whether some people get distracted and they end up in other parts of the industry that maybe they shouldn't be in, they still like learn more about Bitcoin and they kind of get further inside the Bitcoin funnel. And some of them may, if they don't do the research, they may get shaken out when the price of Bitcoin falls drastically. And just like Bitcoin, this same analogy, I guess, can be applied to Bitcoin miners. Maybe or we saw this, many miners back in 2021, were riding high on the massive margins that miners were earning. Many miners got way over leveraged and over their heads, borrowing too much money, and now we're kind of they're going to be paying the price when margins are falling, the value of their rigs that they own are dropping significantly, and maybe when you account for their interest payments that they have to make in addition to their smaller margins, maybe they're not even breaking even on their mining operations. So during these troubling times for many miners, many are having to liquidate rigs to find other buyers. They're capitulating their Bitcoin treasuries, and maybe they wish they could be buying more miners now, but they're just not buyers in the market because they didn't position themselves in a conservative manner last year. And so the opportunity now, like you're kind of alluding to, is that not only is Bitcoin down, but Bitcoin mining rigs are down. So Bitcoin mining rigs are this unique asset where you can buy it and it has high beta correlation to Bitcoin, and you also earn that Bitcoin dividend per se.
Yeah, spot on. I mean, if you think about like that analogy with a variable and a constant, um, we've talked about Bitcoin capitulation in general that leads to negative price action, and we've talked about minor capitulation. Irrespective of the reasons, uh, there's a lot of frog in the throat. Excuse me. The variables in or the constants in these analogy, nothing has changed about the Bitcoin network. It's the same monetary policy. It's the same decentralized money. All of the properties are the same. It's deflationary assets, so on and so forth, right? And nothing, again, in this analogy, there are different miners and there's constant innovation, but the miners haven't changed. What's changed are the kind of market dynamics. So if you couple that with increasing adoption and that whole adoption kind of psychological journey from awareness, whether for good reasons or bad reasons, leading to education at some conversion rate, right? You get more educated folks, you get adoption, and now there's effectively a catalyst to adopt because you're either buying the same thing with the same properties or you're buying the same thing that same rig that did the same thing 6 months ago at a sharp discount. So it kind of looks out into the future and say, well, if you think these variables will manifest, maybe not tomorrow, maybe not in 6 months, maybe not in 2 years, whenever this happens, it leads to a really kind of generational opportunity, in many ways. And that's where we see institutions now. I mean, an insight that we get a lot of insights from miners, different folks, retail, institutional folks that are buying rigs. And an interesting data point is, at our organization at Blockware, our transaction numbers are about the same in rip roaring bull markets as they are in, dark days like they are now. It's the sideways period. The buyer dynamic shifts because it moves to this, dry powder, gathering, sold high mentality, pump in low, blood in the street kind of, play. Right. I mean, that's a bit of a ramble, but I think it ties together a lot of the points that we've talked about today. And, really, we could all use some good news, right? It provides, certainly an upside opportunity if you look at it with the right perspective.
Yeah, Danny, I think you made some great points, and I'll just add a few more thoughts real quick before we wrap it up. I know we've been talking for over an hour now. I know Hash Rate Index, Luxor guys, put out some great data for Bitcoin mining specifically. And, a fun, interesting fact that I just pulled up, you could have bought, on the market from Blockware, from other people, you could have bought an S19 in November 30th of 2020. The market price was around $4,000, which at the time was about 0.18 BTC. And in June of this year, so this is, almost 2 years later, price was about the exact same, both in Bitcoin and both in dollars. And obviously you mined a ton of Bitcoin from the end of 2022 or the end of 2020 to June 2022. So something to keep in mind out there.
Spot on, man. Cool. Well, to your point, we typically run these for like 30, 45 minutes. We've doubled that today, but in fairness, we did take a couple weeks off, and there's no shortage of news to discuss. So, appreciate everybody speaking, and most importantly, everybody tuning in. We do these monthly. We'll do the next one in August, the next month, and in the meantime, if we always like feedback, and if anybody's interested in learning more about Blockware or getting into mining or getting further into mining, we'd love to hear from you. So, any final words, guys? Otherwise, we can wrap it up.
No, thanks a lot, everybody, for tuning in. This was awesome, and I know this one was a bit longer than usual, but there's no shortage of stuff to talk about, so rightfully so.
Yeah, thanks everybody.
If you came in late, this will be on YouTube, so don't worry.
Right on. Cheers, guys. Take care.
Later.